Talk of the tape. Is the unthinkable really possible? Could the Fed actually hike interest rates by 100 basis points at their next meeting in just a couple of weeks? The market's now betting on it and then some. Let's ask former Dallas Fed President Richard Fisher. He joins us now live. Mr. Fisher, it's good to have you back. Thanks, about Scott. This? Raphael Bostic said it a little while ago, quote, everything is on the table about that possibility. Quote, today's numbers suggest the trajectory is not moving in a positive way. Should they go 100 in a couple of weeks?
Well, first, I have great respect for Raphael, but remember, he's not a voter this year, and those are his opinions, and we'll just have to see as we get closer to the meeting what's likely to obtain. There are pros and cons about 75 or 100. I would say presently 75 is still the most likely outcome. The pros of 100 are you get ahead of the curve, which they're way behind. The negatives are, once again, you could surprise the market from what was claimed to be the path they were on, 75 basis points. So I think it's too early to turn that determination, but this is a bad number, Scott. And even if it starts narrowing down, it's going to be way too high relative to their goal.
Richard, I'm going to try and pin you down. I mean, if you're sitting in the room, okay, like you once did, do you make the argument for 100?
I was the most hawkish member of the committee, I think, Scott, if you remember. I would still argue for 75 here. And at the same time, I'm looking further down the road, and I would expect that's another possibility in September. We'll see what they come out with at the meetings that they have in Jackson Hole in August.
So why not rip the Band-Aid off, Richard? You said it yourself. It's a bad number, Scott, right off the outset here. Let's just get it over with. Just do it already. Inflation is blisteringly hot, even though some metrics suggest it's starting to cool in some places, but not others. So why not just go for it?
Well, I think it's important to just have articulated a path. We all know they want to go to 3.5, right? So that's sort of the goal right now. Why not just continue along that path, not look like you're afraid, you're overreacting? The big issue here, Scott, is not the price of goods. We're seeing some of that stuff come off, commodities, et cetera. It's the wage price spiral that we're in the midst of right now. Workers are not being paid enough to keep up with inflation. They're going to demand more. They have bargaining power. And that's going to be the real issue. How do you cut that off? And that's the argument for doing something even stronger. But I don't think they're going to go in that direction. We'll see. You never know.
But Canadians do you think they think, like Jim Cramer does, that this is the last of the really hot numbers? Because that's ultimately what this comes down to.
Yeah, it may not. It could be the last, but it doesn't mean you're going to go back to the 2% plus that they're aiming for. They have a long way to go between this number and 2. Heck of a long way to go. So they want to bring it back down. They want to see a series of declines, and we're not seeing that right now. So whether it's 9.1 or 8.2 next meeting or whatever it may be, it's still not enough. They have a lot to do, and workers are demanding more and have the negotiating power. As long as that's the case, we're going to have inflation driven principally by the service sector, but by all corporations will be under pressure, and we're going to have to tame it. That's the Fed's job.
It's interesting that you say they have a lot to do, and they clearly do. The question is at what cost? And the Wharton professor, Jeremy Siegel, who was on with me today on Halftime, suggests they're not going to be able to do as much as they once thought because the economy is deteriorating faster than a lot of people thought it would. That is going to ultimately force a pivot. Do you agree with that?
Look, the economy is a mixed bag right now. From the standpoint of employment, it's still doing well. We're seeing some leakage, but still look at that unemployment number and look at the number of unemployment claims. And as long as that's strong, and it's not the target we used to aim for, which, by the way, was 6%. Now it's in the 3.6 area. As long as that's the case, and you hear Powell saying this, the economy looks stronger on that dimension, even though it's looking somewhat weaker on other dimensions. So I have great respect for Jeremy. There's nobody better. But we'll have to see. And I don't think, as long as we have had inflationary pressure, that the idea of a shallow recession is going to scare the Fed away.
Yeah, so I was going to ask you about that, what they would be content with. And do you think a soft landing is possible, as Bullard has suggested in the last couple of weeks?
It's possible. It's historically unlikely, but it's possible.
Doesn't sound like you'd be putting any money on it.
I'm hopeful that this could be achieved. Again, the question of recession, Scott, is how deep is it? How broad is it? And right now, if we have these kind of weak numbers we're seeing from the Atlanta Fed, which, by the way, is never a great predictor if you look at the statistics behind that. But as long as we have those kind of numbers in the first quarter numbers, Scott, this is shallow and not necessarily could be tremendously damaging